Hi everyone, I'm Pamela Hastings and welcome to another Barometer Webcast. Along with my fellow relationship managers, Tanya Kramarska, Lori Ouellette, Shavana Persaud, Harrison Baptist, and our new partners from our recent merger with Roundtable Capital, Jim Allen, Jeff Speidel, and Peter McCarthy, we welcome you so warmly to another broadcast while we all stay safe and shelter in place. Joining me today is David Burrows, Chief Investment Strategist at Barometer Capital Management, and we will also hear from Brian McNichol, our Senior Portfolio Analyst. During this webcast, we will provide you with a review of current market and economic conditions, and of course, at the end of the broadcast, we will address your questions. As always, we encourage questions from participants via the chat, or you can email me at phastings@barometercapital.ca. If we are unable to address your questions, we will follow up with you after the call. And with that, I turn the conversation over to David Burrows to provide us with an update on the market conditions and as well our economic conditions. Thanks, David.
Hey folks, thanks so much for tuning in. It's been a week, some more water has passed under the bridge, and we are in this process where the market is trying to assess how long the quarantine is going to go on, how the opening up is going to go, which industries are going to win, which industries are going to lose, and we are spending a lot of time trying to understand the message of the market to make sure that our portfolios continue to be relevant. It's been obviously a very interesting time. We've been trying to do three things. We're trying to really try to identify where the strength is in the market, what the key structural themes are that are benefiting from the changes that are taking place. Obviously, there are some groups that are winning. There are some groups that are hurt badly by this environment. And we're 7 days further along in the market doing its sorting. We have to look always for new leadership to emerge. We don't have to be everywhere. Certainly what we're trying to do is be targeted only in productive assets. Doesn't mean that because financials are a big part of the market, we have to be there. We should be there if it makes sense, if we have a tailwind, if the security is in a position to be revalued favorably. And of course, we're also trying to understand risk and where the risks lie and be prepared to be on the sidelines in certain parts of the market or for a substantial amount of the portfolio if it was necessary. So I want to just quickly run through where tactically we are positioned, what we're avoiding. We're going to talk about a couple of our themes, and then we can take some questions. So as most of you know, we believe that we've been in a structural bull market in stocks since 2013 when we took out the 2000 highs. A market had effectively gone sideways for 13 years. Structural bull markets tend to go on for a long time, 15, 18, 19 years, and they certainly have interruptions like the 1987 crash. But they tend to be short and sharp and over fairly quickly. We'll see whether that is the case right now. If this was the end of a structural bull market, it's not impossible. It would be the shortest structural bull market in history. But we have to sort of keep assessing it as we go along. We also have had a premise that we were coming toward the end of a generational move down in long-term interest rates, which last bottomed in the late 1940s and turned up in the early 1950s. And what's interesting about that is it ushered in a series of sectors that did particularly well for the next 30 years. And they were not the things that had done well through declining interest rates. So it's important for us to be watching for that because ultimately we are at what could be described as generational lows. And if there was ever an event to stop economic activity in its tracks and put us in a position where interest rates could be, low in the extreme, we've been going through it. So the baseline view is we've held this long-term uptrend in the US stock market since 2013. We briefly dipped below and traded back above that trend line. So the base case is we're in a structural bull market. The NASDAQ has been the strongest part of the market over the last number of years, going back all the way to 2008, and continues to be stronger than the rest of the market. But we're going to take a dive inside the market and really see where the strength lies. We don't have to be everywhere. There certainly are themes that are not well suited to the current market environment. So a familiar sight, this is the dive that we took in February and March. The market had a couple of steps forward, an initial technical bounce. It then pulled back. It rallied a second time on fiscal stimulus and a slowdown in the COVID cases. And we have now been talking about the fact that we are in a period of doing work. So this is a shorter term picture. This is from sort of the middle of March through the bottom and the rally that's ensued since then. So over the last few weeks, we said we'd rallied, we've entered a phase where the market is going to do some sorting. And sorting is really important. When you have a major low in a market, you have lots of things that rally. You have high quality companies well suited to the current environment. That's real buying taking place. And then there's going to be some buying in securities that are not well suited, that have been hurt really badly in the decline, and that people sold short. But once the market starts to rally, they have to cover their short positions. What's important is when the market starts to mark its way sideways after an initial big rally, you start to see the buying in the stocks that were short covering, the buying starts to dry up. And we get to see the market do its sorting. We watch very closely. What is it that continues to behave constructively? What is it that weakens back off again? We look at what is strong relative to the market, what is weak relative to the market, so that we can continue to refine the holdings in our portfolios. Look, I want to be clear. We don't want to own everything. We're targeting structural themes that have a tailwind given the current economic environment. And as that changes, we want to change our holdings because we are active managers. We do want to be tactical. Okay, so from the top, at the market level, we believe that a healthy market should see an ever expanding list of companies participating in a rally. That's buying spreading to more and more securities. When the market bottomed at the end of March, only 2% of the S&P 500 companies maintained an upward bias. In other words, everything sold off. And when this number gets below 30%, it tends to be you're getting close to a market low. We showed in the last call back to 1997, all of the times we had seen the market get washed out. And we showed that in 2009, you had an initial lift in October that failed. We sold off into March, and then we saw market low. So here's what we've seen in the S&P 500. Breadth has expanded from 2% over the next several weeks, got to a point where 90% of stocks in the S&P had participated in the rally. And that's great. And then the market went into this workout, this sorting phase. And since then, while lots of stocks have continued to do well, many have started to give it back. And as we sit today, as of this morning, 76% of stocks are in long-term uptrends, meaning that 14% of stocks that had been doing well have started to roll over, give it back. And we want to watch really closely the nature of those companies that have started to give up their strength, because it tells us those are areas of the market that have mushy demand where they may be challenged given the current environment. And we want to understand, does it make sense? When we look at the NASDAQ 100, we went from 4% of stocks performing well to 92%. And since then, it's been backing off. 72% of stocks in the NASDAQ continue to be strong. So the market is narrowing a little bit. It's doing some sorting. When we look at all of the companies on the NYSE, and there's like 1,500, we track the percent of stocks trading above their 50 days. So 150 days. So you can see that the 150-day moving average, that's a smoothed average of the last 150 days of price, is falling, and the market is trading below the 150-day moving average. So some people use that as an indicator of trend. If you're trading below the long-term moving average and it's declining, it means that ultimately you're still in a downtrend. If we took all of the markets in the world and look at the percentage of global indices that are trading above their 200-day moving average, you can see that's in the dirt. So around the world, markets are still struggling. Right? Most markets trading well below their highs. The US market, the strongest in the world, really off the bottom. So it tells you that the majority of world stock markets are still having a difficult time. They may have had a nice rally, they may have had a nice bounce, but they're still fighting their way out of this situation as the economic and healthcare crisis sort of unfolds. In the US, 12% of stocks are trading above their 150-day moving average. So it means still really 88% of stocks are in the prove it to me phase. They're still trading relatively weakly relative to the market. And we're not interested in that. We're interested in the winners. We're interested in the ones that are performing well, the ones that are well suited to this environment, where sponsorship in the market is strong and people are willing to put money to work in these companies. So let's talk about some of those themes. From the period we went into the decline and from the period we started to bounce, technology has been leadership in the market. This has been the most important theme. And there's no question that this healthcare crisis has moved people along in the adoption of various technologies that is not going to go away after things get better. So there have been people willing to commit capital to technology. And this is, you'll see on all of these charts, there's a line underneath here at the bottom. If it's rising, it means that the sector or the theme is outperforming the market, is rising relative to the stock market. If it's declining, it's weakening relative to the market. So technology is an overall theme, strengthening relative to the market. Within technology, semiconductors have been a clear winner. Semiconductor companies obviously benefiting from the move to 5G technology and wireless. And there's lots of semiconductors being produced, lots of equipment that is necessary. And the companies, despite the economic slowdown, are performing well. Cloud-based computing companies, companies that are levered to selling cloud-based services, the things that we're all using when we're working here from our homes. Again, big beneficiary of the environment coming into this sell-off and people recognizing they will continue to be whether we're sitting at home or not. Big beneficiary there we talked about last week was Microsoft, great earnings, great market share in cloud, great market share in software as a service. Other technologies that are winning, digital payments, right? Our own Canadian company, Shopify, reported earnings yesterday, knocked the cover off the ball. This is a mini Amazon. This is a big holding of ours, significant outperformer, winning in this environment. And I think that the move to online retail is not going away once things start to get better. Electric cars and automation. This is an ETF that houses companies that supply into that ecosystem. Very, very strong relative price performance versus the market. Very clear winner in this environment. From a healthcare perspective, healthcare in general, obviously lots of demand for healthcare services. Companies within this group, within biotech, have been doing particularly well. Companies in the pharmaceuticals and testing, we talked about Abbott Labs. We know what's been going on with Gilead. We own Regeneron. All of these companies working toward therapeutics, and all of these companies have the attention of the investing community going forward. In the consumer, certain areas of consumer discretionary are doing well, certain areas not doing well. Obviously, Amazon is a big winner in this environment. Online retail, the gaming companies, Activision, Blizzard, Electronic Arts would be another. These are companies that we're focused in. And then there's the precious metals. We're going to talk a little bit about precious metals today. I've got Brian McNichol on the line. He's one of our key portfolio managers. Brian's been with us several years and focuses on individual companies within specific themes that we're focusing in, finding ways to express a view against these long-term secular themes that we look for. What I've started here with is a picture of the price of gold going all the way back to 1989. And you can see, like other assets, they go through these multi-year rallies and then multi-year periods where things aren't so rosy. But that sets up the next move. And we believe we've entered the next large move in the price of gold. Now, when I started my career in the 1980s, I watched gold top out and go through a long period of underperformance. And I had an older client who phoned me up in the early part of 2000 and started buying gold companies. And I am not a gold bull. I was not a big believer. He said, look, this will happen a couple of times in your career. and you need to be ready and waiting for them. Of course, he made an enormous amount of money on the investments that he made. Well, I think that we've started the next major phase higher for the price of gold. Now, if you think about it, it makes some sense given what's going on with monetary policy around the world. Money printing is rampant, but certainly gold is making new all-time highs in all currencies: euros, Canadian dollar, Japanese yen, Australian dollar, all the way around the world. Against currency, gold is outperforming. So we look for themes that benefit given the current economic backdrop. We know central banks around the world are printing money and taking on debt. We know that fiscal stimulus is being bumped up everywhere to try and offset the stoppage in our economic development, something to try and keep things going. And so through all of this, growth stocks tend to do quite well because they can trade at higher multiples when money is easier and there's lots of liquidity. And gold stocks, of course, benefit. Now, if I use the tools that I use to try and look at where things are going, I do a lot of point and figure price charting. We can use the price pattern in a point and figure chart to try and understand what the trajectory could be. And I can tell you, based on two ways of looking at things, we could be looking at somewhere between $2,650 and $3,000 as an ultimate target. And as you know, we're around $1,700 today. So the price of gold can go materially higher. If we look at gold relative to the stock market as how it's performing, we know there have been periods of time where stocks do really well relative to gold. And then when gold starts to outperform, stocks do relatively poorer to gold. So there was a big move through the 1940s, 50s, and 60s for stocks, and then gold had a giant run into the early 1980s. You had a big move in stocks through the 1980s and 90s into 2000 where they peaked out, and then gold had a giant run into 2010-11. So what I would say is we've just started to see gold outperform the stock market. Now, that doesn't mean we go all in that specific theme. We have weightings in gold of around between 10 and 14%, depending on the portfolio. We have been more focused, though, on the equities. So this is an ETF that owns gold equities, GDX. It's a basket of about 100 gold companies. You can see that it did sell off with the market, but immediately bounced back and went on to new highs and has been working its way higher on a relative basis, as we mentioned, outperforming stocks as a whole. But when you look at it, stocks in the gold sector have underperformed for many years versus gold, based out, and are now starting to outperform. So the stocks are starting to outperform the metal. And that's important because when the stocks outperform the metal, it tends to be a more sustainable rally. So I wanted Brian to talk through a couple of the companies that we own. We try to identify these structural themes, and then we try to express our investment by finding companies that are good getting better, where they have some natural advantage over their peers to perform better in the market and be revalued more favorably. So Brian, do you have a couple of thoughts on Newmont?
Yeah, definitely. So Newmont is a top 3 global gold producer. Majority of their assets are in really strong mining-friendly geographies. And we view their portfolio as very defensive. So taking COVID out of the equation for a second, their production will stay stable for the next 5 years with no acquisitions baked in. And on top of that, management has publicly stated that costs over this time will decline nicely. So what we have here is a portfolio of very long life assets with reducing costs, which is truly a very rare find in the gold space. So in this current gold environment, Newmont is expected to generate significant free cash flow. 50% of this will be reinvested back into the company, with the remaining used for debt reduction and also returning capital to shareholders through buybacks and dividends. So we saw strong evidence of this strategy last week as Newmont increased their dividend by 78%. So while Newmont has been affected by the COVID, with governments ordering the shutdown of a number of their mines in March and April, at the beginning of this week, Newmont's management reported that 90% of production is back up and running, and there shouldn't be an issue of them reaching their full year guidance and having what will be an outstanding year. So as Dave mentioned, at $1,700 of gold, we should be getting 2.5 billion in free cash flow this year, followed up by 3.2 billion next year using the same price. So as long as the price continues to rise, then the overall cash flow outlook will just get stronger.
Great. So Brian, maybe talk a little bit also about Franco Nevada, which is a company we've owned for quite some time.
Yes, it's definitely been a core holding of Barometer during my time here. So large cap gold royalty company. They own a diversified portfolio of royalties partnered with high-end producers, either in the late stage of production or currently under development or exploration. So the royalty business is a very, yep.
I jump in just for a second. So what I've always found interesting about Franco is its business model. And, you know, for those that don't know, Franco Nevada effectively finances gold companies, and they provide capital so that they can build out and grow. And in return, they wind up with a perpetual royalty on the production. And so they wind up getting a royalty, and I think today something like 160 mines. And interestingly, when the sector goes out of favor and nobody wants to finance gold companies, they wind up being sort of the financier of last resort. And that makes them a little bit unique. Sorry, I just wanted to jump in on that.
No, that's quite right. That's actually what I was about to jump into. The main reason why we love Franco so much is their ability to show growth in both the bull and bear markets of both the precious metals and base metal, cycles. So in bull markets, Franco will be looking for organic growth from their large portfolio of operating and developing projects, where, similar to what David said, in bear markets, they take advantage of depressed valuation and acquire top quality assets. So using the current environment in which we're in base metals such as copper, where we're seeing depressed pricing, copper companies are in dire need of equity to help fund projects or fulfill debt obligations. But the demand for both equity and debt markets are not there for a deal with investors such as ourselves. So this is where Franco steps in, provides capital to these companies in return for any gold stream that comes along with the project. So typically, they yield very strong returns down the road. Franco has been able to average a 25% return on capital for these types of investments. So they're out there right now making some very strategic deals. So while some of the gold projects in their portfolio have been suspended due to COVID, we're very pulled up on their top class management team and very strong balance sheet, which will allow them to weather the storm and actually emerge stronger from this. So core principle for Franco is their sustainable dividend, as they've consistently grown for the past 12 years. So while there are fears out there of sustainability of dividends during this time, the company expects to maintain that trend in 2020 despite COVID, publicly stating a few weeks ago that along with their earnings today, we should see a dividend increase.
That's great, Brian. I appreciate that. I think Franco Nevada is a great sort of poster child for the type of business that we look for. You know, we use our top-down work to try to understand when money starts to get put to work in a group, and when breadth gets particularly narrow, it generally means the group is underowned and unloved. When I say narrow, it means only a few companies within the industry are performing well. The rest are performing poorly. When breadth starts to expand, investors who wouldn't otherwise be in that sector start to look at the group and say, where would I put my money? So we try to identify the one or two companies that, despite a really tough environment, have had a business model that was sustainable and were able to grow. And we'll start with partial positions. If the group starts to work, we'll look to broaden our ownership. So we started with Franco Nevada, which we've owned for a long time, despite the fact the group was out of favor. We added Newmont, we added Barrick, we added Nova Gold, which is a significant development company. And so today we have 6 or 7 or 8 major holdings in the precious metal space. And we'll stay there so long as the sector remains supportive, so long as the individual companies perform the way that they're supposed to, both fundamentally and from a price perspective. And we'll run stop losses up and behind them to continue to own them as long as they perform. And ideally, when we find these themes, these are multi-year themes, and often the companies start to look expensive relative to recent history, but it's because they're being revalued in a new environment. And so that's just a really good example as to how we wind up in a sector and how we build out our ownership. Okay, so to go beyond those groups, and those are clearly haves, there are some real have-nots. And a lot of groups rallied off the bottom and then have started to give it back. So one example would be the financials. And of course, it's a big group within the market. Canadian investors tend to really like the banks and the financials. They had a tremendous decline. And when the market rallied, even through the rally, you can see we're relatively underperforming. And with the first sign of any weakness in the market, and I said we've seen some deterioration in breadth, you're seeing them back off. So for instance, the weakest ones in the group, like Wells Fargo is actually taking out its low from the sell-off in March. So that's a company that we have looked on the other side in our long short portfolio to be short. So as a result, we have a very low financials weight, specifically banks and insurance companies. We do have some financial technologies doing well, but this is a group that we have actually been reducing our weight in through the course of this rally. Industrials would be another group along the same way. Now, both of these groups are dependent on economic growth coming back. So we see the stock market rallying. People say, well, it must be that everyone expects the economy is going to get better more quickly. And I would say that these groups are telling you, no, in fact, it may be longer for the economy to come back because they're highly economically sensitive and they are relatively underperforming and making new relative lows versus the market. Again, source of cash for us to be reducing our weights. Transportation stocks, similarly, nice bounce. This would include the airlines and the courier companies and the truckers, relative new lows versus the market. And then a couple of defensive groups, which you expect people might like to have because they pay a nice dividend, but they've started to relatively underperform. And those are the real estate investment trusts, probably more impacted by things like the shopping center REITs and the office REITs, and utilities. Now, interestingly, utilities have been very broadly owned over the last couple of years, people looking for the dividend in a low interest rate world. But you can see have really been suffering from a relative price perspective. And through that period, some of the defensive sectors that we owned and defensive positions, even though stronger than the group itself, we've been just slowly reducing our weight in utilities because it looks like something is afoot. Now, what could that be? Well, one of the things that we've watched closely are bond yields and bond prices. So as bond prices go up, this is the price of a very long-term US government bond. Prices go up means interest rates are coming down. So at the height of the sell-off, US bonds hit an all-time high. They pulled back, they bounced, and then the bond prices have started to weaken again. In other words, interest rates have started to tick a little higher over the last couple of weeks. Now, that's an issue because people have been piling their way into the bond market looking for safety at lower and lower yields. And we've been saying that we think that this is a risk. When you think about how people are positioned, they've been big buyers of bonds and they've been big sellers of stocks. And now we're seeing bond prices start to fall. So it's possible we are seeing a generational low in yields, and that has implications because what works in rising rates is different than what works in falling rates. What works in falling rates? Utilities, telecom, consumer staples, real estate. What works in rising interest rates? Things that have an innate ability to grow their dividend. I think it's interesting. This was pointed out today that by Jeremy Siegel, that bonds just hit the top end of a 25-year trading range, bounced off it and have started to pull back. So it's possible we are seeing a generational peak in bond prices or bottom in interest rates, and that could have significant implications. So what would drive stocks higher longer term? Money moving out of bonds. What would also move stocks higher longer term? Money moving from cash. We know that we have record stockpiles of cash in client portfolios around the world. And we know that money's been coming out of stocks, so they're relatively under-owned. So in the near term, we have a market that's doing some sorting. There are some sectors that are winning, some sectors that are losing. The overall firepower that could come back into the market is substantial. Fund managers in general under-own equities. And if we saw rates start to rise, well, that drove in the 1960s and 70s a giant bull market in stocks. So we have to be aware of that. We recognize we're all afraid of declines, but certain conditions are really favorable for stocks. Now, it may take longer, it may take a shorter period of time to come out of this global pandemic, but we want to watch for change at the margin. And what we are seeing is some change in the way that securities are behaving that are most tightly tied to bonds. Things that have had a tailwind for several years that may not have that same tailwind going forward. Stocks can do really, really well in a period where rates are rising, but bonds don't. So we think we're in a structural bull market for stocks. We think we're in a workout period. We're watching very closely at the groups that are deteriorating. We do have some cash in the portfolios. We are focused in largely tech, healthcare, some consumer discretionary companies that are benefiting from the structural changes that are taking place. We have relatively low weights or no weights in things like financials, certain areas of industrials. We've been reducing our weights in utilities and REITs, and we look forward to these changes continuing to unfold. In the end, we think that this will turn out to be a generational opportunity to be positioned in the right groups, and we'll use the breadth tools that we have to try and recognize some of the shifts that are taking place. If things are rolling over and are going to retest and pull back to test the initial lows, I'm not sure that that's the case, but we will be more than willing to play defense. We've done that in every major decline in the past. We certainly are prepared to do that again. I said 3 or 4 weeks ago, we are moving into a phase where we have to maintain flexibility. So we have some cash, we've got some defensive positions, we are not out over our skis, and we are watching every day for changes in the major structural themes, and we'll continue to update you as we go along. And bit by bit, we will move toward the groups that continue to work. So with that, Pam, if there's any questions, maybe we could open it up.
Hey, Dave, I have a question here regarding Fed stimulus. Do you think that Fed stimulus will prevent a test of the March lows?
So there's no question that the Fed has learned from previous instances of crisis where they really stepped in with both feet to provide liquidity, to make sure that we didn't wind up with the financial conditions that were so tight that it would cause a credit crisis. And even this week, they talked about the fact that they would begin a bond buying program in corporate bonds and even ETFs that own corporate bonds. So they're working hard at maintaining liquidity in the market. And there is an old saying, which is don't fight the Fed. At the same time, we are fighting an economic environment like we've never seen before. And so I said a few weeks ago, we're likely to see a battle between the liquidity being provided both by central banks and by governments using fiscal stimulus, and on the other side, really nasty economic conditions. I don't want to make a bet on the whole market because there's industries that are really challenged right now. We just want to try and find those groups that are benefiting from the current environment. I don't want to forecast. What I would say is this: the areas that we're focused in are behaving extremely well. We'll keep assessing those daily. There are parts of the market that tell me that there's some damage under the surface, and those are the most economically sensitive groups, and we're avoiding those. If our breadth models were to continue to weaken, then we will become more defensive. And whether that's a 5% pullback just to test the initial rally, or whether it turns into a full-blown retest of the lows, I can't tell you. I do think that the Fed has made it clear that they're not done. So I think if the markets start to get sloppy, you're going to see more stimulus pushed in. Now, all of that would be great for our gold positions, but we'll have to see. And if we see more changes, we'll continue to update you guys.
Dave, really quickly, I know you addressed gold. We'd love to get some insight on our positioning with respect to oil and gas.
Well, that's a $64,000 question. Being in the Canadian marketplace, you can't help but look at energy. In the U.S., oil and gas was the fastest growing industry in the U.S. for 10 years, probably provided the most jobs any industry. And of course, it's been well documented what's happened as we gone through this stoppage in the economy. Look, when oil rolled over from $160 a barrel in 2014, that was the end of a parabolic move higher in share prices. And whether you look at tech stocks that finished a parabolic move higher in 2000 and then took 16 years to really regain their old highs, or the financial crisis where financials rolled over and got crushed, and it took, well, it's taken until this year for them to get back to where they were in 2007. It's going to take some time for oil and gas. I had a chart here on commodities. This is commodities since 2010, and a big part of this decline, you can see, was driven by oil, but certainly by other commodities as well. Just like stocks, commodities have long secular bull markets and bear markets, and they've been in a bear market. You know, we talked about the fact that gold has sort of deviated away from the rest of commodities and started a really significant rally. It may be that it's the first of others that will make a turn, but it's really hard right now to commit capital to a group that's been hit so badly. This is a picture of the USO, which is the oil ETF, recently come down from 100, got as low as 16, and bounced to $20. So lots made of the fact that oil's had a great bounce. And certainly there's a lot of young millennial investors who piled money into this thinking that it would turn around sort of immediately. I do think that the long-term picture for oil is challenged because the technologies that we use to find oil, fracking, are so effective that in effect you have a 98.9% chance of success when you drill a hole today. So if you could do it profitably, you can raise all the money you could possibly raise. Today, we have production way in excess of demand. And I think that the industry is going to go through a significant workout. If you looked at the XOP, which is an ETF that holds a basket of the oil and gas producers, from a percentage point standpoint off the lows, it's had a huge rally. But I think it's going to take time for this to develop into something that's more sustainable. So for the industry as a whole, I would be careful. Our strategy is we try to find a couple of the strongest companies in the sector after a sector's become hated, ones that could withstand and actually can benefit in a weak environment. And Canadian Natural Resources is one example, and significantly outperforming the sector. Suncor is another, but there are partial positions. They're small relative to our holdings, and like golds, if we started to see this expand and improve, then you might see us slowly build out some weight. But I prefer to see something that looks more sustainable before we take on a significant position.
Dave, we have another question. And it's just sort of related to our approach with respect to displaying historical information. So maybe you can speak to that. The question is, if we are in unprecedented economic situation, how relevant is the historical information that we use to interpret the market? And how is that applied when we make an investment decision?
That's a great question. Really good question. So I ask people to look at it this way. What causes change in the market is different every time. The way people behave is incredibly repeatable, right? We're driven by the same things all the time. Now, the market is a giant machine and there's 1,000 moving parts. And at any given time, different ones of those 1,000 moving parts are the things that people focus on. But prices are moved by a combination of all of those things. And so there are some constants, right? There are some constants in the way the market reacts to stimulus, whether it's monetary or fiscal. That has an impact on liquidity and credit markets. Fear plays a major part and greed plays a major part. if you took any asset class over any period of time and looked at the way a structural rally takes place, in every case, the strongest assets start to perform well first while there's tremendous fear. And then as acceptance changes, buying starts to spread over a larger and larger number of assets until late in an advance, you'll get to a point where people are willing to buy almost anything that has a marker on it that calls it the same name as that rally. So if it was gold stocks, Franco Nevada was doing well before the gold sector was doing well. It became the leader in the group. Others have joined the rally along the way. And now there are people phoning to say, surely there's some that haven't gone up yet. And that's people reaching for the weakest securities, hoping that they'll get dragged along. My point is that what drives economic conditions changes, but cycles unfold the same way every time. I know that so long as everything we own is in groups that are seeing expanding breadth, meaning money is being put to work, there's no bear market ever took place while breadth was expanding. And breadth could be expanding for 1,000 different reasons, or a combination of 1,000 different reasons. When breadth starts to contract, it means the weakest assets are starting to roll over. There's not enough buyers. Now, why is it that people are leaving the sector or theme? Could be any number of 1,000 reasons. We always want to try and understand that and how long it could go on for. But the fact that it's happening is just a fact. When breadth is deteriorating, risks are higher. We have to be cautious. So we use these breadth models and looking at history to understand what can happen. We don't know what will happen, but I think it's our job to look back over many, many cycles and say, well, here are a number of things that happened in a similar way in the past, and do they rhyme with the current environment? And then is breadth doing what it's supposed to be doing given what we think we know? So I'm not sure that answers it in 4 seconds or less, but the fact is what causes markets to move changes, but people behave the same way over and over again. And so if we understand investor behavior, then we can understand the most likely path going forward.
Dave, thank you so much. I think we're going to wrap up this particular webcast just with respect to time. I know that there are a couple of questions that we need to address offline, so I apologize if we were unable to address your questions today, but we will follow up with you. And we'd like to thank you so much for joining our webcast, and also a heartfelt Happy Mother's Day to all the mothers out there. This weekend on Sunday is Mother's Day. So Happy Mother's Day.
Pamela, what do we have on next Wednesday?
Oh, well, we have a special guest. We will send out the particulars later this week, and we hope that you guys can join us next Wednesday for that.
I think next Wednesday we have Leland Miller, and Leland Miller has a company called China Beige Book. And Leland has an army of data collectors on the ground in China, has for several years, and he provides consulting to the Central Bank of China, PBOC, as well as other central banks. And what's interesting about his work is he collects data as to what's happening real time in businesses. So he's going to, I think, be able to give us some color on how the recovery is unfolding in China. And of course, they started the process a little bit earlier than in the US. And I think he'll be able to give us some pretty good insight. So I'm looking forward to that call.
That's great. So thanks everyone for joining. We will address those remaining questions offline. We hope that you have a great rest of your evening and stay safe, and we'll see you next Wednesday. Thanks, Dave.
Thanks everybody for tuning in.